Well, Martin, thanks for joining.
Hi, Joe. Thanks for having me.
So why don't we dive right in and you just tell listeners, what is Incisive Ventures about?
So Incisive Ventures is my VC fund. I'm a pre-seed VC, which is I define as the first institutional money into B2B software companies. If you have an idea and you're still building the MVP, I consider that the angel round. That's not an institutional round. I like to come in after you've got an MVP in the market for a couple months, you've got maybe a couple, 2-3 customers, and you're really trying to scale it up into $400,000 or $500,000 of ARR, where the seed funds get interested in writing you a $3 to $5 million check. I'm a solo VC. I was a 3 times venture funded CEO, so I've been in the operator seat, and I think that's what a lot of founders appreciate is that I'm not just an MBA guy coming in asking them for spreadsheets. I've been in their shoes, and I think that's what a lot of founders appreciate from me as a VC.
So what drew you to pre-seed? I'd say your brand, anytime someone comes across you online, you're very clear and consistent on you do pre-seed and Incisive. What specifically about pre-seed draws you relative to, I know in prior firm, you've done some Series A, which is very successful. You've done Angel, but what is the sweet spot for you there?
Well, the funny thing is I love talking to 2 or 3 guys and a dog. I just think that's the most exciting part of a company journey. I've done it 3 times as a CEO. I'm very animated when you've got that idea going. And I think that's the most creative time where pivots happen and things like that. So I like working with companies at that stage. Once you get into the A or the B, it's a lot more just about scaling, blocking and tackling, hiring people. And for me, that's not as interesting as, who's the customer? What's the product? How does it work? And that's what's really being done at pre-seed. The interesting thing, I made a post on my blog of definition of stages between angel, pre-seed, seed, and A. And one of the things that's happened in venture is that the number of stages has really expanded. When I started in venture, the first round any company would do would be the Series A. When I was at Ignition, we led the Series A of DocuSign, which was their first round. They had not raised any money before, and they raised $4 million in a Series A. But with the explosion of venture capital and stuff like that, the stages have expanded. Right now, Series A's are more like $10, $20 million raises, after you've got $2 million of ARR. So it can be a little confusing to some people, but there are multiple stages. And in my mind, pre-seed is the first time institutional investors, people who invest other people's money instead of their own, are getting involved in companies. And it's early relative to today's Series A investors, because today's Series A investors really want to see like $2 million of ARR, which is a lot of traction for a company to get. And typically you have to raise money before that. I love the pre-seed because it's 2 or 3 guys and a dog, and there's a lot of work to do and a lot of interesting problems to solve. One of my mantras as a person is I like to have hard problems to solve every day. I'm super bored if I don't have hard problems to solve. I tried to retire 2 or 3 times. I suck at retirement. I hate golf. I need problems to solve. And pre-seed companies have problems aplenty.
Plenty of problems to solve. Yeah.
Problems aplenty.
So your core thesis, we invest in technology companies that reduce friction and scale.
Yeah.
That sounds very DocuSign, but I'd love to hear more about that and get you to expand on the thesis behind the firm.
It is very DocuSign because that was my experience. But the reason it's a valuable investment thesis is that businesses will always pay to increase revenue or decrease expenses. There are always opportunity. They will always pay for that. If you're doing something B2C where you've got some new app and maybe people like it, maybe they don't, they can switch to something else. That's really hard. If you're developing hardware that takes, 10 $10 million, $20 million before you make version 1. That's really hard for a small investor as well. If you're doing drug discovery that takes $100 million before the FDA tells you whether you can sell your product, that's really hard. But what I've found is that B2B software, many times for a couple $1 million, you can get a pretty clear answer of, can you build it? Will people buy it? And will they pay you a price that you can make money at? So they're very capital intensive, that are capital efficient, those kind of businesses. I invested in one company in Africa. I led the pre-seed. We gave them $300,000. Within a year, they're profitable on the $300,000 raise. This is possible in B2B software. It's not possible in many other categories. So the other reason I like it is that I'm a small fund, and so I'm investing small amounts of money, $250,000 to $500,000. What I want is the biggest bang for that small money. It's, I think, very hard to be a small investor in companies that are going to require tens of millions of dollars before you get an answer if it works. So the other thing I noticed is that there are plenty of industries that have friction. Healthcare, supply chain, construction. I invested in a company that builds software for storage unit owners. Nobody in the fucking world is building software for the storage unit. Like it is an old industry that uses paper and pencil and fax machines still today. And so you can make a huge impact with software. The other thing why I like that model is, the meta trends are in your favor. It's cheaper than ever to build industry-specific software. I love places where people are like, we're using Excel, and now we can write a custom app to replace Excel. Excel is a great platform and was a great general purpose tool, but specifically built vertical market software is better, and it's cheaper to build now. It's possible to build it today, whereas it wasn't possible 10 years ago to build a specific app. And I'm seeing an explosion in vertical market software because the cost of building that software has come down dramatically.
So I want to weave together a couple different question from a couple different things you'd mentioned. So you talk a lot about benchmarks that you see for deals. There's an article on your site where you reference them. It comes up in conversations, and you reference their, doing a deal in Africa. I'm curious, what are the traction metrics? How much more traction do you want to see? And what do you see as kind of market clearing rates on differences between U.S. deals and emerging markets? Because I certainly see differences there as far as investor expectations, but as someone who's focused on that and as a firm that does both, I'd be curious to hear what you think.
I do about 60% US, about 40% international. And I do the international deals in partnership with VC funds where I'm an LP in those markets. I think it's really hard for a US investor to invest internationally unless they have a partner on the ground that's doing the local due diligence and meeting the founders and stuff like that. So, that's the only, I think, good way for US investors to invest internationally. I started doing it for two reasons. One is there certainly is, in many cases, a valuation arbitrage. For example, this company I invested in Africa, it was a Stanford GSB guy who wanted $300,000. I think we did it at a $3 million valuation. In the Silicon Valley, that would have been a $15 million valuation, and his $300,000 would last like 3 months. But in Tanzania, it was done at a lower valuation, and that $300,000 got him to profitability because the cost of running the company in Tanzania was an order of magnitude cheaper than running it in Silicon Valley. I invested in another company in Sri Lanka. Sri Lanka's economy cratered. You can have engineers for $10,000 a year that are the best engineers in the country. So there is a cost arbitrage and a valuation arbitrage. And in the Sri Lanka company's example, for example, second-time founder, all their customers are in America. So I think there's an interesting arbitrage of having your cost basis be in a low-cost environment, your customers be in a high-revenue environment. That's something that's possible in today's market that was not possible 10 or 15 years ago, right? So I like that arbitrage. And in terms of metrics, I look at the same kind of metrics in pre-seed, not necessarily valuation. I would expect to see a little bit of a valuation difference, but traction metrics. I want to see that you have a couple customers. And I want to be able to talk to customers. Are they validating that what you're building is the right thing? And I want to see your thin edge of the wedge. Like, what's your pipeline look like? How many customer discovery calls did you do? How are you going to get to market? Because the reality is that most ideas, there's going to be 10 or 20 people building. And the real difference is your ability to get those first 10, 20, 50 customers. And so the metrics I look at in pre-seed is, how are you getting to market? And is the initial feedback in what you've built good, or how much more do you have to build before customers are going to pay you real money?
I talked to a banker at South by a couple weeks ago who was from LATAM, and he had a hesitation with investing in startups out of LATAM. And I realize LATAM is not your sweet spot, but we'll just take this broadly as an emerging question, that there isn't as developed a cycle for acquisition or exit from his perspective. And I'm curious, how you think about that with the countries you're investing in.
Yeah, international is certainly less capital efficient in terms of all things. Follow-on fund. I mean, LATAM for fintech, follow-on financing has gotten, easy to get, but the exits are harder to get. That's definitely true. And it's the same in Africa. And what you just have to do as an investor is to make sure you're getting in at the right price and that the company's creating a fundamentally sound business. I don't think about exits. If you're thinking about exits, for example, I posted something on Twitter about this. If you have an exit slide as a founder in your pre-seed deck, that is a huge red flag. You should not be thinking about exits. You should be telling me how you're going to build an incredibly valuable business. The exits are going to take care of themselves. And, people that were investing based on certain exit multiples have always had a problem. I didn't invest in any of these B2B, SaaS companies in seed that were, raising at 100x revenue. Most of the guys who did that got crushed because public markets are 6x revenue. And the exit values of these things are going to change over time based on the public markets. And, whether you have public markets at all, or whether you have big companies that are doing M&A at all. And big M&A in the US has gotten, cold water thrown on it by the government and stuff like that. So exits are always a problem. I don't, in pre-seed, think about exits. I think about, can you build something that customers will pay for, and can you raise money for the next round? And can you get to profit? I am thinking about how you get to cash flow break even or profitability much sooner. I want you to be close to cash flow break even into Series A. And I want to have a reasonable path to get there. Many in the bubble in 2020 and 2021, people were like, oh, you don't have to be profitable until the IPO. It's a very good thing for the overall startup ecosystem that people are expecting you to get to profitability sooner, because once you're cash flow break even, you don't have to worry about exits. You just have to run the business. And I think it's a benefit to the overall system that there is a more focus on being capital efficient. All of that said, those rules are out the window in AI right now. We're still in crazy times in the AI companies, people raising $1 billion seed rounds and stuff like that. I unfortunately don't think that's going to end well.
One story I've heard you tell is, as an angel, you were pretty loose with writing checks to more or less anything that was referred over to you and looked interesting. I'm being a little glib, but you were in the story too.
Absolutely.
Obviously it worked out. Yeah, it worked out very well for you, to be very fair and clear. But now that you're running your own firm, other end of the spectrum, very selective institutional process. But I think in particular, given your public profile, I would guess that there's an inflection here that hasn't happened yet. It probably will soon, where the volume of deal flow you start to get, it gets very large. And as a solo GP, I'm curious, how you approach that and how you're thinking about approaching managing, an ever-growing list of opportunities crossing your desk with your scale.
Yeah, well, I mean, that's the difference between being an angel and being a professional pre-seed investor. As an angel, I was seeing 20 or 30 companies a month. I see 300 now. So I get a lot more context in who's building what. I see the same idea 20 times in a month. As an angel, I wouldn't do that. And it's actually harder to make decisions if you're picking from a smaller pool. The other side of that problem when you have a big pool is to figure out what to pay attention to. I can't even look at 300 decks. You spend 3 minutes on a deck, 300 decks. I'm full time just looking at decks, right? So I have written some software that I use a form on my website. People can still cold email me, but I prefer that they put the thing into the form, because in the form, I have some scoring algorithms that goes in and scores it against my thesis. And I'm also very transparent about what my thesis is. That's why I talk on Twitter. I'm like, I'm pre-seed. I define pre-seed as this. You have to have an MVP done. I don't invest in crypto. I don't invest in hardware. And the funny thing is I still get crypto investors pitching me, which is fine. But I have logic that automatically filters them out so that I don't even have to look at the decks. I still don't understand why they're pitching me, because I say right on my profile I don't do crypto. But that's fine. So I have had to write some software that helps me manage the pipeline. I have an AI thing that looks at a deck and compares it against my thesis and my stage and stuff and scores it. And all of this scoring basically tells me, out of the 300 pitches that I get a month, which 60 should I look at and which 20 should I take a meeting with. And I think you need some automation and some tools as a solo VC like me, and I've built those, and I have a venture partner that helps me build those. I think I'm already at that, like too much of a fire hose to handle type of a thing. But automation and data analysis is going to be key, and every VC should do it. And the funny thing is that's not really a general thing that you could do. I think each VC has to. I built mine specific for my thesis, right? And each VC has a different thesis, so they need to build their screeners to work on their thesis. And some VCs might want, are generalists. They're any good deal type VCs. They're like anything. So they have a pretty wide open thing, and they might want to look at more deals. I have a pretty constrained thesis, so it's actually a little bit easier for me to filter the opportunities because it's pretty constrained.
You'd mentioned AI valuations running hot to absurd earlier, and you'll sometimes see 20 different ideas or versions of the same idea. What are the flavors of the month that you're seeing right now?
Well, one interesting one is, I was a crypto guy. Now I'm an AI guy. That I get that. I don't know how many times I get that. I don't do those deals. And, I define, I see there's 3 different opportunities in AI. One is the core infrastructure for AI, the LLMs and the new audio and video models that are coming out and stuff like that. Those are hugely capital intensive businesses. Those are not opportunities for a small fund like me. The second part is dev tools. There's a lot of people building things that help you connect and stitch together AI things. I'm also not primarily a dev tool investor, so I don't invest in those. The third category is applications. And while a lot of those companies on the application layer will call themselves AI companies, I don't call them AI companies. If you're an application layer company, you're solving a business problem. You happen to use AI because it is a tool that helps you solve this business problem better than you could have solved it without AI. I don't think those are AI companies. Those are just fucking B2B software companies. So what I look for in an AI company is a B2B software company that is using AI to solve some problem that was previously intractable. So, for example, one of my portfolio companies is called Aristotle HQ. And they're in the business of monitoring your contacts in your CRM online, LinkedIn, Facebook, Twitter, and all that stuff, looking for potential changes in buying signals, potential changes in nudging and reach out signals, and then generating messages to engage your contacts in your CRM. this is something that a good sales rep would do, but it's an intractable problem for individuals to do for 20, 30, 40,000 people in a CRM. It is a tractable problem to do with AI because AI can stalk everybody on the internet for cheap. So this is a fundamental business process that lots of people know to do, but it was impossible to do before AI. This is a very good opportunity. I don't necessarily call that an AI company. That's a business company, right? It happens to be using AI to solve a problem that was previously intractable. So I stay focused on the business problem. What business problem are you solving? Does AI allow you to solve it in a way that was unsolvable before? Okay.
Other than AI evaluations running pretty hot and generally a frenetic interest in the space, what is a consensus view in venture that you think is overrated?
Where somebody went to school matters. I see a lot of VCs saying, oh, Stanford GSB, here's a check. The data shows that that's not highly correlated.
I agree and feel very seen having gone to a state school and hearing that. So
I went to a state school too.
All right.
But the data proves otherwise. Yeah.
You've mentioned in the past that a mistake that you think early investors make is getting too hung up on the reputation of co-investors in a deal. Be curious to hear about that and, in the topic of status, but why you think that's the case.
So the co-investor signal is another thing I think that is highly overrated by other investors and by founders too. I remember I was pitched by a founder one time, and he said, Peter Thiel's investing. I said, oh, really? How much is Peter investing? $50,000. I said, oh, did you talk to Peter? Well, no, I talked to one of his guys. Oh, which guy? And he mentioned a guy who was like a principal, not even a partner. And I said, I bet you Peter doesn't even fucking know he wrote that check. He can, $50,000 is like a penny lost in his sofa. So you're trying to tell me that Peter Thiel loves what you're doing and he doesn't even know he wrote the check. Like, this is one of the most overused tropes in venture. So the first thing you do when you're looking at co-investor is, is the amount that was invested. People come to me all day and like, Sequoia Scout invested. Okay, $25,000. Sequoia also doesn't know they wrote that check. So that doesn't tell me that Sequoia is going to do the follow-on round. So it's incredibly overvalued. You got to compare the check size with who it's coming from, how many checks they write, what percent of their fund is it, and many times it's not a meaningful commitment. What I look for more is, was it a meaningful commitment by a very smart, intelligent person? And many times it's not. Which is the problem of overvaluing the co-investor signal. Because when they say so-and-so is investing, you got to say, okay, how much of their fund is it? Is there actually a partner on it? Is this a deal that they're really committed to? Or are they, trying to save one of their, potential losers or something like that? You got to dig a little deeper. And you got to do your own work. The venture is littered with these stories of YOLO people. I mean, look at Theranos, look at, WeWork. Lots of smart people thought that other smart people were doing the diligence. Look at FTX. And, it turns out the other smart people weren't doing the diligence. They were just following other people that they thought were smart. This is a common error in venture capital. I try not to fall for that. I do try to invest with other smart, committed people, but I have to validate, are they smart? Are they, in fact, committed? Right?
Well, on that note, kind of maybe turn a little bit to portfolio construction. Curious how, you'd mentioned the geographic mixes and being just within pre-seed that, it kind of narrows things a bit. But I'm curious how you approach, let's call it like range of investments within the fund and how you think about follow-on.
I have a super simple fund. I do $250,000 first checks. I have no reserves. I want to put 30 checks in the fund. In my prior investment track record, I did 74 investments. 6 of them were unicorns. That's an 8% unicorn rate. That's crazy high. If I'm able to replicate that in this fund, it'll be an 8x fund. I have no reserves. I'm just trying to get enough bets because it's an outlier business, and in some ways you got to plan on the math. If you were picking unicorns by throwing darts, you would find a unicorn like 0.01% of the time. And AngelList says if you want a shotgun to get a unicorn, you need to make 300 investments. And, that's fine if you're writing $1,000 checks as an angel. That's not fine if you're writing $250,000 checks. You got to have a process that's has a higher probability of making unicorns, which is what I think I have. Which is my portfolio construction is, $250,000 first checks, institutional, and the best CEOs I can find. No reserves. I do get pro rata, and I do offer my pro rata opportunities to my LPs in SPVs so they can get a direct investment opportunity. There'll be about $40 million of pro rata generated from my $10 million fund. So I do that as a benefit to LPs. But portfolio construction is I'm just trying to get 30 at-bats in the best companies in my thesis that I can find. That's it.
Is there a future where you do something along the lines of a growth fund or a continuation fund, however you'd want to frame it, rather than SPVs?
Potentially. But personally, I'm an LP in 17 funds, and I designed my fund this way because it's the fund I want to be an LP in. And in fact, I'm the largest LP in my fund. Because what I want as an LP is I want a manager to sort through the 3,500 deals that I did last year to do 7. On the pre-seed, because pre-seed's really hard to make decisions. And then I want the option as an LP to go into the best ones that I like as a direct at a lower fee structure. I do my SPVs at 0 and 10. The opportunity fund is interesting, and I potentially might do it because there'll be people that want to commit to every opportunity that I do. But as an LP, I personally like the optionality of being able to decide on a deal-by-deal basis instead of doing a committed fund. So for now, I'm going to stick with the SPVs just because that's what my LPs want to do. If I have enough LPs that want to do a committed fund and have me make the decisions, I'll consider that, but I'm not considering it right now. Because you can do the same thing with SPVs at a lower fee rate.
I'm curious to ask about valuations. So I've seen data out from Carta, speaking of pre-seed valuations, that would look, and AngelList data points in much the same direction, which would be pre-seed seed valuations are pretty firm, relatively speaking. Now that's based off medians, which makes it a little apples and oranges, but nonetheless, the narrative is those valuations pretty firm. Is that anecdotally from your experience on the ground, do you feel that that's the case relative to 18, 24 months ago?
No. That data is being distorted by YC and some of these other large fund AI things. In my portfolio, prior to this fund, I had done 66 investments in pre-seed. My average entry valuation was $10 million. In the last year, my average entry valuation is $8 million. So I've seen pre-seed go down roughly 30%. And I think that's a good thing. It might be just because of who I'm selecting. I'm not doing, $20 million pre-revenue YC companies. And YC is still doing that and still getting those deals done. I don't understand them. Some of them will probably be fine. 2 of my unicorns were YC companies. YC is a great program. But I think that they are lagging in terms of valuation. Basically, what they're doing for pre-seed companies is saying raise at a seed valuation with pre-seed traction and hope you catch up. And that, if it works out, it can be okay. The problem is the pre-seed investors don't get paid for the additional risk that they took, because you end up doing flat rounds a lot. So I'm simply not doing those. I'm going to miss some companies that may end up being unicorns because of that, but that's my model.
When you talk to a founder and you're really interested, but there might be, we'll call it a big mismatch in expectations around valuation, maybe you avoid that conversation to begin with, but if you do come across it, you are really interested, how do you approach that conversation?
Well, the good part, I think, is that, until about 18 months ago, all investors were basically price takers, right? The company said, here's the valuation, take it or leave it. The round's closing by Friday. I don't think that's a good environment for anybody, because it's the wrong balance. There's not a discussion to be had. So today you're able to have that discussion. I have renegotiated valuation. And I'm not just happy because there's at least the ability to have the conversation right now. It's the ability to have a conversation with the CEO, based on my experience and what I think he's going to happen. If he's raising at what I think is too high a valuation, like for example, if he's pre-seed and he's trying to raise at a seed valuation, I have the conversation. I say, here's why it could be a problem for you. It could be a problem because your next round's a flat round or down round. Do you want that? It's going to be hard to attract investors because they're not going to get a return from this round. If the CEO doesn't even want to listen to that, that tells me something about their ability to be coachable or to have a reasonable conversation. And it's usually a negative signal. I'm a small investor. I don't lead rounds, so I, typically don't determine the terms. But what I want to do is have the conversation and see what the CEO says. And if they're, curious, open, to the conversation, have reasonable thoughts on it, that's a positive signal. If they're like, the round's closing on Friday, tell me yes or no, that's an incredibly negative signal.
So this has been a great conversation. Really appreciate it. I want to end it on a high note. Maybe could you give a shout out to one of your founders that you're invested with, who you're just thrilled with how they're executing?
I'm super excited about Aristotle HQ. I mentioned it to you before. The founder's out of Sri Lanka. He created the largest, his name's Hesh Fernando. He created the largest telemedicine company in Sri Lanka, and this is his second company. He's really passionate and driven. I was in Sri Lanka this summer and went surfing with him. He's a great guy. I love hanging out with him, and he's building something that I think is really important.
Awesome. All right. Well, thanks for joining, Martin.
Thank you.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.